Welcome back to the Deep Dive. We are jumping right into the AAON Inc. third quarter 2025 earnings call.
Yeah, and this one was really something.
It wasn't just another report, was it?
Yeah.
This felt like a real defining moment. We saw this, explosive market reaction.
Totally explosive, but nuanced.
Right. So our mission here is to really unpack the story behind that stock movement.
And it's a great case study. I mean, you have this incredibly high conviction in their future growth, right? The data center story is real.
But it's paired with this massive acknowledged execution risk that is just slamming their margins right now.
Exactly. So we have to look past the headline beats, to really understand if they can turn this huge backlog into actual high-quality revenue in 2026.
Okay, let's start there. Let's start with the numbers that got everyone so excited. $1 billion in revenue.
It's a big number.
A huge number. That's a 17.4% jump year over year. And it absolutely smashed the street's estimates by about 14%.
And that momentum, it flowed right through to the bottom line. GAAP diluted EPS came in at $0.37.
Beating consensus by 4 cents.
And 4 cents, yeah. And critically, that's almost a 100% sequential improvement from Q2. So management is clearly starting to get some operational leverage back.
Which they desperately needed after the middle of the year.
Oh, for sure.
Okay, but we can't just celebrate the top line without, addressing the big caveat here.
The profitability picture.
Exactly. This is where the whole narrative gets a bit muddy.
It's the core conflict, right?
Yeah.
So despite all that strong revenue, gross margin landed at 27.8%.
And year over year, that's not good.
No, it's a brutal decline. It's a 710 basis point compression, a huge drag.
But there was a silver lining, or at least one that management was pointing to.
Right. The one saving grace they focused on heavily was that the margin improved 120 basis points sequentially from Q2. They're trying to say, look, this is the inflection point.
An operational inflection point.
But, let's be real. 27.8% is still way below where they need to be to justify this kind of valuation.
So if profitability is struggling, where's all this revenue coming from? Let's unpack the growth engines, because there's one very clear star of the show.
Oh, yeah. It's BASX.
BASX, the specialized high-density data center cooling segment.
BASX is the rocket fuel here. Their branded sales almost doubled. They were up a phenomenal 95.8% year over year to $124.8 million.
Wow.
This just validates the entire strategic shift they've been making to chase data center and liquid cooling infrastructure. It's not just a trend for them, it's structural.
And when you look at the visibility into the future, the momentum isn't just there, it's actually accelerating.
Exactly. The total backlog reached this astronomical record of $1.32 billion.
Which is more than double where they were a year ago.
Up 104% year over year. But let's get even more specific. The BASX brand backlog grew 119.5% to almost $897 million.
Just for that one segment?
Just for BASX. Think about that. The backlog for their specialized segment is almost $900 million. That's what's giving investors so much confidence for 2026.
So if BASX is growing at nearly 100%, what's happening with the legacy AAON brand? The traditional rooftop unit business. Is that old business just getting starved?
It's stabilizing. I'd say it's playing catch up. AAM branded sales were essentially flat year over year, down maybe 1.5%.
Okay.
But sequentially, which is what you watch for the manufacturing recovery, they rebounded 28.1% from Q2.
So they're getting the factories back online.
They are. It's directly tied to getting production throughput up at Tulsa and Longview. Tulsa is basically back to prior year levels, which is a huge relief.
For Longview.
Longview's still lagging, maybe, 20% below full output, but it's slowly crawling back.
But even with that production rebound, you mentioned lead times are still an issue. That must be preventing them from really monetizing that traditional AAON business.
Oh, absolutely. Management admitted lead times for that segment are still about 50% longer than they'd like. They're sitting on this huge backlog they just can't process fast enough.
Because of all the operational friction.
All the friction, growth and system upgrades at the same time, getting that Longview ERP rollout sorted is it's paramount for them.
Let's talk more about that friction. It's the biggest investor concern. That 710 basis point margin drop is painful. Where is the drag coming from?
Well, it's a classic case of, growing too fast, trying to fix the engine while you're flying the plane. The drag is mostly from two big things.
Okay.
First, the pan at Longview is tied directly to that ERP implementation. Rolling out a complex system across a huge live factory is never seamless. It just kills efficiency.
Right. Training, Inventory management, all that stuff.
All of it. It drives up costs in the short term.
And the second source of the drag.
The second is all the unabsorbed fixed costs from the new Memphis facility. I mean, they're adding nearly 800,000 square feet of capacity.
But it's not all online yet.
Exactly. You still have to pay the rent, pay the salaries, absorb depreciation on the new equipment before it's actually churning out profitable units.
And they put a number on that, didn't they?
They did. For the quarter, it was an estimated $4.5 million in unabsorbed costs, and that was just within the Oklahoma segment.
Wow. That really puts the margin pressure in perspective. It's not a demand problem at all.
Not at all. It's a CapEx and operations problem.
Yeah.
And that's exactly why they brought in the new COO.
His mandate must be pretty clear then.
Crystal clear.
Yeah.
Take the painful lessons from Longview and apply them immediately. Standardize manufacturing, optimize the ERP rollouts. I mean, the big Tulsa ERP implementation is scheduled for the second half of 2026. They have to get Longview stable first.
So 2025 is really just an execution year.
It's all about execution.
Okay, so given all this friction, what confidence did management give on their forward-looking numbers? They did raise guidance, which is a pretty bullish signal.
They absolutely did. They raised full year 2025 sales growth up to the mid-teens. That was from low teens before.
And what about margins?
They guided full year gross margins to 28 to 28.5%. So that implies they see this sequential improvement continuing right into Q4 and early 2026.
What about the CapEx chatter? Some people saw the guidance reduction and thought they were cutting back on future capacity, maybe for BAS.
Yeah, and management was really quick to shut that down.
So that wasn't accurate.
No. They reduced CapEx guidance from $220 million down to $180 million, but they were clear it was purely a timing issue.
Just couldn't spend the money fast enough.
Exactly. Supply chain and labor constraints on the construction. The funds and the plans are just shifted into 2026. So the long-term BASX growth story is, fully intact.
It's fascinating they're driving this growth despite what they called a soft commercial HVAC macro environment. How are they pulling that off?
Well, they're just not playing in that soft, low-margin general market. They're winning by being the go-to specialist for high-performance stuff.
Like what?
They specifically highlighted their Alpha-class air source heat pumps. Bookings for those are up 45% sequentially. They're perfect for national accounts, big retailers or government clients who are all focused on decarbonization.
So they're solving a complex problem that the smaller, more general players just can't touch.
Precisely. And the data shows it. National account bookings were up 96% of the quarter. It's a powerful strategic move that insulates them from the normal construction cycles.
Now, we have to talk about the Q&A session. It got pretty contentious when they had to defend the business against that recent short seller report.
They were ready for it, though. They came out swinging with a really comprehensive defense.
The main claim was about their revenue recognition, right? Especially for BASX.
Yeah, and management just firmly stated that their financials are fully compliant with GAAP, specifically ASC 606.
Okay, for our listeners who aren't CPAs, what does ASC 606 really cover here?
So ASC 606 is all about how you recognize revenue from contracts. For AAON, especially with BASX, a lot of orders are these huge custom solutions-based systems.
Not just off-the-shelf products.
Right, and the short report alleged they were too aggressive in recognizing revenue. Management's defense was basically, no, our process, which uses things like percentage of completion, is totally compliant with GAAP for these kinds of complex, long-term jobs.
The other big claim was about low-margin liquid cooling contracts and this kind of concerning rise in contract assets on the balance sheet.
And they had a very mathematical answer for that. First, they just flatly denied the low-margin claim.
Yeah.
Said these are custom solutions and priced appropriately.
And the contract assets.
Second, that increase was almost solely due to the timing of one single massive custom liquid cooling order they got late last year.
How massive are we talking?
They said this one order was nearly the size of the entire BASX segment's revenue from the prior year.
Wow. Okay.
So the cash payments just lagged way behind the revenue recognition because of how custom the contract was. They said it's temporary and that it should reverse, turning cash flow really positive in Q4 and into 2026.
All right, now for the segment everyone's been waiting for. We've got the narrative. Massive growth, but major near-term execution risk.
The classic setup.
This is not financial advice, but let's put on our trading hats. How could you play this tension?
Well, we have to start by saying, again, this is purely speculative. Don't take this as investment advice. You have to acknowledge the complexity here.
It's a long-term data center bull versus a short-term execution bear.
Perfectly put. The stock's up 15% in 3 months, but still way behind the S&P for the year. The valuation is high, but the risk is real.
So you need a trade that buys into the 2026 story while hedging against, a near-term stumble. How do you structure that with options?
We could pitch a combination strategy. You could start with a deep-in-the-money call option on AAON, maybe expiring in early 2027.
Why deepen the money?
Because it behaves a lot like owning the stock. It has a high delta, but it takes less capital up front. It gives you leverage if management executes, and that BASX backlog converts in 2026.
Okay, that's the bullish side. How do you hedge the immediate risk? Say Q4 margins miss or the Tulsa ERP gets delayed.
To help fund that expensive long call, you'd simultaneously sell a far out-of-the-money put option that expires sooner, like in Q1 2026.
For listeners who aren't options traders, break that down. Why does selling that put cover the execution risk?
Okay, so selling an out-of-the-money put means you collect a premium right away. That lowers your total cost for the whole trade. You're basically betting the stock price won't drop below a certain level by early 2026.
And if it does drop because of an operational slip?
If it drops, the premium you collected helps offset the loss on your call auction. It's a way of acknowledging the near-term risk and using the option structure to, help pay for your long-term bullish bet.
So to sum it all up, Q3 was a really critical inflection point for AAON.
It really was.
It confirmed their role as this go-to specialist in data center HVAC and just completely validated the strategic pivot to BASX with that record-setting backlog.
Yeah, the question isn't about demand anymore. The market has made that very clear. The foundation is set. But now it is purely about execution.
Right.
And so the final challenge for you, the listener, is this. Can the new COO, with all the painful lessons from Longview, stabilize margins and get that massive Memphis facility running fast enough? Can they turn that $1.3 billion backlog into high margin revenue through 2026?
Because if they can, the current valuation is probably justified.
And if they slip, the stock is vulnerable. That operational conversion, that is the one single metric to watch in the quarters ahead.